Welcome to Breaking News to Trading Moves. Today, we are looking at a textbook case of how positive clinical data gets turned into, well, pure competitive capital.
We are. We're focusing on Capricor Therapeutics. They just secured $150 million on the back of some very promising news from their Duchenne muscular dystrophy program.
And our goal today is to really get into the market consequences of this. I mean, when a clinical stage company raises this much cash, that money doesn't just sit there.
No, it immediately starts flowing through the entire biotech ecosystem. So we're going to trace that flow, identify which companies and sectors are set to gain, and on the flip side, who's now facing a bit more pressure because of it.
Exactly. We're following the money. For you, the listener, this is about understanding the chain of events that goes way beyond just Capricor's own stock. It touches service providers, competitors, even the big pharma giants. So let's start with the specifics of the deal itself. How did Capricor pull in $150 million?
Okay, so the mechanics are pretty straightforward. It was a common stock offering. They announced the sale of 6 million shares of their common stock.
And the price?
The pricing was set at $25 a share.
$25. And that's actually, a key detail. This wasn't some sort of desperate, heavily discounted raise.
Not at all. Raising that much money at a price so close to where it was trading tells you there was very strong institutional demand. Real conviction in the Duchenne asset, which is called Deramiocel.
It all comes back to the data they presented.
It always does. And on top of those 6 million shares, the underwriters, the banks running the deal, they also got an option to buy more.
The over-allotment option or the green shoe?
Exactly. They could purchase up to 900,000 additional shares at that same price.
Which is pretty common when a deal is hot. And if they exercise that in full, we're looking at another, $22.5 million?
That's right. So the total could be well over that $150 million base figure. It gives the banks a tool to help stabilize the stock price after the offering and just gives Capricor even more financial runway.
Okay, so we have the source of the funds. Now, the big question is, where is all that money going?
It's targeted at two main areas, and this really lays out their strategy for the next few years.
Let me guess. The first is the Duchenne program.
You got it. The biggest chunk, the most immediate use, is for advancing that late-stage DMD cell therapy, Deramiocel.
And why does a program like that just, soak up so much capital?
Well, DMD is just a devastating genetic disorder. It's progressive, it's fatal, and it mostly affects young boys. Because the unmet medical need is so high, the regulatory bar is also incredibly high.
So you need bulletproof data.
Bulletproof data from very large, very long, and very expensive trials. We're talking phase 3 trials, which means recruiting patients from sites all over the world. The logistics alone are a massive cost center.
And it's not just running the trial, right? There's more to it.
Oh, absolutely. You have to start preparing for commercialization way ahead of time. And cell therapies like Deramiocel aren't like pills you can just churn out.
It's the manufacturing challenge.
It's a huge manufacturing challenge. You need to build or secure specialized GMP-compliant facilities. That's good manufacturing practice. You have to prove you can make the therapy consistently and safely at scale. A lot of that $150 million is basically an upfront investment to be ready to supply the market if the drug gets approved.
Okay, so that's the main program. What was the second area you mentioned?
The second area is about the underlying science. A portion of the capital is going to their exosome platform.
Exosomes. So these are tiny vesicles that cells release?
That's right. Capricor is developing them as a sort of delivery vehicle for different kinds of therapies. By funding this platform, they're showing to the market they're not just a one-trick pony.
Ah, so it's a diversification play. They're signaling that the company's future isn't tied 100% to the fate of Deramiocel.
Precisely. It gives investors, especially the big institutions, more confidence. It tells them that even if the DMD program hits a snag, there's still valuable technology and a future pipeline in the works. It helps de-risk the whole story.
What really strikes me here is the timing. This ability to raise $150 million, it wouldn't have been possible without that strong Duchenne data, would it?
Absolutely not. In biotech, data is currency. A clean clinical win, especially in a rare disease with high pricing potential, it just erases so much perceived risk overnight.
And that's what gets the banks and the investors on board.
That's what gets them excited. The banks feel confident they can place the shares, and the institutional funds are eager to buy in. If that data had been just okay, or even mixed, a raise of this size at this valuation would have been a complete non-starter. They really picked their moment perfectly.
All right, so that sets the stage. $150 million in the bank, aimed at a pivotal trial and platform expansion. Let's start looking at who benefits from this.
Okay, so let's turn to the winners. The companies and sectors that are positioned to benefit from Capricor's newly filled war chest.
And when a biotech gets a big check specifically for trial execution, the first in line to get paid are usually the service providers.
Almost instantly. That capital has to be converted into action, into trial progress, and that means revenue for a very specific group of companies.
We're talking about the big clinical research organizations, the CROs, names like ICON, that's ticker ICLR, and IQVIA, ticker IQV.
Exactly. This is the operational reality of drug development now. A company like Capricor has the science and the capital, but they don't have the massive global infrastructure to run a phase 3 study.
So they outsource it.
They have to. And a fully funded pipeline at Capricor means a direct, immediate, and large increase in demand for the services that these CROs provide.
Let's get a bit more granular on that. How does Capricor's $150 million turn into revenue for, say, ICLR?
Well, a late-stage study is a logistical beast. You have hundreds of clinical sites around the world that need to be managed, thousands of patient records to track, and complex regulatory paperwork for every single country. ICON, ICLR, specializes in exactly this kind of large-scale trial execution. Capricor's board approves the plan, and soon after, a multi-million-dollar contract is signed with a company like ICON to actually run the trial on the ground.
And what about IQVIA? Where do they fit in? Their ticker is IQV.
IQVIA's strength is more on the data side of things. They are leaders in clinical data services, analytics, biostatistics. A late-stage trial, especially for a complex cell therapy, generates an unbelievable amount of data.
And that data has to be collected, cleaned, analyzed, and stored securely.
Yes, and that's a specialized skill. Furthermore, regulators are increasingly asking for what's called real-world evidence, data on how the drug performs after it's approved in the real world. IQVI is a major player in designing and running those kinds of studies as well. Capricor will be buying these high-end analytical services with its new cash.
So for these CROs, it's pretty predictable revenue. Once Capricor announces the raise and the purpose, it's almost like a pre-announced sale for ICLR and IQV.
It is. It gives analysts who cover those stocks much better visibility into their revenue for the next year or two. And what's key for these CROs is they have high operating leverage.
Meaning they've already built the infrastructure.
They've already built the global platforms, hired the experts, developed the software. So when a big new contract from a client like Capricor comes in, a large portion of that revenue flows directly to the bottom line because the marginal cost to service it is relatively low.
So that's why their stocks often react well to broad biotech funding trends. Capricor's capital is seen as high-margin revenue for its operational partners.
Exactly. The CROs are the picks and shovels of the biotech gold rush. They provide the essential services, and they get paid regardless of whether Capricor's drug ultimately succeeds or fails, insulating them from that binary clinical risk.
Okay, so moving on from the direct service providers, let's talk about another group of beneficiaries, the established leaders in the rare disease space. Companies like BioMarin, BMRN, and Sarepta SRPT.
Right. Now, these companies aren't getting a check from Capricor, obviously, but they benefit in a more indirect, sentiment-driven way.
This is about sector validation.
It's all about sector validation. When Capricor succeeds in raising this much money off the back of strong Duchenne data, it reinforces investor confidence in the whole rare disease thesis.
And that thesis is what exactly?
It's that these diseases, while they have incredibly long and expensive development paths, can lead to very high-priced drugs with long patent protection if you succeed. Capricor clearing both a clinical hurdle with good data and the financial hurdle with a big raise. It just lowers the perceived risk for the entire category.
It tells the market that capital is available for these tough, expensive programs.
Precisely. And that's good news for established players like BioMarin, BMRN, which has a whole portfolio of rare disease drugs, and Sarepta, SRPT, which is a major force in the DMD market itself.
So Capricor's success validates the very field that Sarepta is competing in.
It does. It validates the commercial potential of the DMD market and, more broadly, the high-cost R&D model that's needed to succeed. It says to investors, yes, this is expensive and it takes a long time, but the funding is there and the payoff can be huge. That helps support the valuations of BMRN and SRPT by removing a layer of systemic doubt.
But hold on, isn't Capricor now a better funded competitor to Sarepta? I mean, they're both going after DMD.
That's a great point, and we'll definitely touch on the competitive pressure later. But from an immediate market sentiment perspective, it's often seen as a net positive.
How so?
Capricor's success suggests the DMD market is large and robust enough to support multiple different types of therapies, cell therapies, gene therapies, and so on. For a company like Sarepta, which is already selling products, it means that the big healthcare funds are more likely to keep allocating capital to the rare disease space, which lifts all boats. It's an affirmation of the entire neuromuscular disease ecosystem.
Okay, that makes sense. Now for our third category of winners, we have the deal makers themselves, the investment banks.
The essential middlemen. The filing names Piper Sandler, ticker PIPR, and Oppenheimer, OPY, as the book runners on the deal.
And being a book runner on a successful $150 million deal is quite lucrative.
It is. They get paid substantial underwriting fees for structuring the deal, marketing it to institutions, and ultimately placing the shares. But the benefit goes way beyond the fees from this one transaction.
This is about reputation and future business.
Absolutely. For mid-tier banks like Piper Sandler and Oppenheimer, who really specialize in this small and mid-cap biotech space, a deal like this is a huge advertisement.
They're competing against the massive Wall Street banks for these deals.
All the time. So when they successfully execute a high-profile, high-demand offering for a company with a hot data catalyst, it proves their expertise. It showcases their ability to read the market and get a complex deal done.
And other biotech CEOs and CFOs are watching this.
They're taking notes. A successful deal like this signals to the whole sector that the financing window is wide open for companies with good stories. So another biotech with, say, positive phase 2 data sees this and thinks, maybe it's our turn to raise capital, and maybe PIPR and OPY are the right banks to call.
So it fills their pipeline for future deals.
Exactly. It creates momentum. Success breeds success. They become the go-to banks for this type of situation, and that can lead to a steady stream of future transaction fees. They benefit from the renewed confidence that they themselves helped create.
So to sum up the winners, you've got the CROs like ICLR and IQVIA getting direct business, the rare disease leaders like BMRN and SRPT getting a sentiment boost, and the investment banks like PIPR and OPY getting fees and a stronger deal pipeline.
That's a great summary. And that movement of capital naturally creates pressure points elsewhere.
All right, let's flip the coin and look at the other side of this. For every action, there's a reaction. And a capital raise like this creates some clear headwinds for other companies.
It does. And the first and most direct pressure is a financial one. And it falls on Capricor's own existing shareholders.
We're talking about dilution.
We are talking about dilution. And this can also cast a shadow over some of its small-cap peers, like a company called Immix Biopharma, ticker IMMX.
So let's stick with Capricor, CAPR first. They just issued 6 million new shares, potentially more. That's a lot of new stock hitting the market.
It is, and it's simple math. The corporate pie is now cut into more slices. So even though the company is in a much stronger financial position, which is great for the long term, each existing share now represents a smaller percentage of ownership.
And the short-term market reaction is often to sell.
Very often. Traders who bought the stock on the run-up after the good data, they see the offering announcement and know a huge supply of new shares is coming. They often sell into that news, which can put a cap on the stock price, or even push it down for a while.
It's the classic biotech trade-off. The good news rally lets you raise cash, but the act of raising that cash kills the rally's momentum.
It's a textbook move. The stock has to take time to absorb all those new shares. Now let's talk about the effect this has on a peer, like Immix Biopharma, IMMX.
Okay, so Immix is another clinical stage biotech, but in a different area. How does Capricor's deal affect them?
It creates something called a financing overhang. Capricor's successful raise basically sets the playbook for the market. Traders see this pattern and they learn from it.
And the pattern is great data is immediately followed by a stock offering.
Exactly. So now, if Immix Biopharma comes out with fantastic data tomorrow and its stock starts to fly, what do you think traders are going to be thinking?
They're going to be thinking the company is about to announce a financing and they'll sell to get ahead of it.
Precisely. They won't let the stock run for days or weeks. They'll sell into the first day or two of strength, expecting a dilution event is right around the corner. It caps the upside for all similar small-cap biotechs that need cash. Capricor's success, ironically, puts more scrutiny on its peers.
Okay, so that's the financial pressure. What about competitive pressure?
This is where we look at the big pharma players who are also in the Duchenne space. companies like Pfizer, ticker PFE, and Eli Lilly, LLY.
Right. For them, Capricor's $150 million isn't just cash on a balance sheet.
No, it's competitive fuel. A much stronger balance sheet for Capricor means they are now a much more formidable competitor in the race to develop a DMD therapy.
So how does that play out? What can Capricor do now that they couldn't do before that would worry a company like Pfizer?
It's all about scale and speed. With this cash, Capricor can afford to open more clinical trial sites globally. They can enroll patients faster, they can lock in manufacturing capacity earlier. In a race to get a drug to market, time is everything. Capricor just bought itself a lot more speed.
And even for giants like Pfizer and Eli Lilly, that matters. They have huge resources, but they also have huge bureaucracies and competing projects.
That's the key. PFE and LLY have their own DMD programs, but now they're facing a smaller, more nimble rival that is suddenly fully funded to go the distance. They can't just ignore that. They can't afford to let Capricor get a big operational lead, especially if Capricor's cell therapy approach proves to have some unique advantages.
So this might force their hand. They might have to increase their own spending on their DMD programs just to keep pace.
They may have to, and that could mean a few things. One, they might accelerate their own trial timelines, which cost money. Two, they might have to dedicate more capital to their own manufacturing scale-up earlier than planned, maybe pulling that budget from another program.
Or a third option.
Or, option three, they start looking externally. If Capricor's asset, Deramiocel, continues to look like a winner, a big player like PFE or LOI might just decide it's easier to buy them than to compete with them. Capricor's funding success basically increases the cost of competing for everyone else in this space.
All right, our final category of companies feeling the pressure is a broader group.
Yes, this group shares Capricor's business model vulnerability, which is a high cash burn, but they don't have Capricor's late-stage clinical validation yet. We're talking about early-stage gene and cell therapy companies, names like Fate Therapeutics, FATE, or Editas Medicine, EDIT.
Now, Fate works on immunotherapies, and Editas is a gene editing company. They aren't direct DMD competitors, so why are they under pressure?
It's about market association. Capricor's big, successful raise is a very public reminder of just how dependent these advanced therapy companies are on the capital markets. Their science is complex and expensive.
And it requires just enormous amounts of capital to get from the lab into the clinic.
Enormous amounts. The manufacturing alone is a huge cost. Building the specialized clean rooms and developing the processes to create these therapies safely and reliably means companies like Fate and Editas burn through cash at an incredible rate.
So when the market sees Capricor raise money, it doesn't just see a success story. It sees a reminder that this whole sector needs constant infusions of cash to survive.
You've nailed it. An investor sees Capricor do this, and they immediately apply that same expectation to Fate or Editas. The thinking becomes, okay, if Fate stock has a big run on some early data, management is probably going to use that strength to sell more stock.
And that expectation of future dilution can weigh on the stock price today.
It acts like a ceiling. It makes traders hesitant to chase a rally too high because they believe an equity offering is inevitable. It limits the stock's upside potential until the company can either get to profitability, which is years away, or sign a big non-dilutive partnership with a large pharma company.
So these innovative companies are in a tough spot. Capricor's financing success reinforces the market's view of their business model as being structurally capital intensive.
It does. It solidifies this idea that for these next-generation therapy companies, a clinical win is just the prelude to a capital raise, and that reality can put a damper on their stock performance.
So this really brings us full circle. We've seen how a single $150 million financing event triggered by good data, sends currents throughout the entire biotech market.
That's right. That cash provides direct support for service providers like ICON, that's ICLR, and IQVIA, IQV. It validates the whole investment case for rare disease leaders like BioMarin, BMRN, and Sarepta, SRPT.
And at the same time, that same event creates dilution pressure for Capricor's own stock, CAPR, and sets a tough precedent for peers like Imix Biopharma, IMMX.
And it turns up the competitive heat on large rivals like Pfizer, PFE, and Eli Lilly, LLY, while also highlighting the funding challenges for early-stage platform companies like Fate Therapeutics, FATE, and Editas Medicine, EDIT.
It's a great illustration of how capital follows clinical data in this industry.
And to leave you with one final thought to consider, how does this now change the M&A calculus in the DMD space? With Capricor now well-funded enough to potentially go it alone, Will a big player like Pfizer or Lilly feel more pressure to make an acquisition offer sooner rather than later to take out a rising threat? Or will they pivot to partnerships to bolster their own internal programs?
That's a key question, as the race for market share in Duchenne muscular dystrophy is clearly heating up.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.